that being said, let's say that I have met with you, I've figured out and explored these different options, and let's just say they over allocate or one of my clients does not get the welcome home funds. How long does that pre-approval last for them if whatever reason we can't get that particular property or we can't utilize the funds? Do they have to meet with you again and go over everything, or is their pre-approval good for a period of time?
Not necessarily. Yeah, so the pre-approval is going to be based off when we pull credit. So once we pull credit and get you pre-approved, that's good for 120 days or 4 months. And after that point, your credit just has to be updated. So if you found out you weren't going to get the welcome home funds, more than likely we're just going to switch a loan program. You have to redisclose some stuff to stay in compliance, and you should still be able to close pretty quickly after that.
Let's jump into some of those other programs. I want to drill down on, especially the neighborhood one.
Okay.
Can you unpack that particular program a little bit more for folks who are interested?
So Republic Bank's neighborhood housing program is specific to Fayette County and Scott County. It is income-based, but it's applicant income. So unlike Welcome Home, where it's household income, if a husband and wife, for example, make too much money together, they can't do welcome home funds, but they could do neighborhood housing if one of them qualified on their own with just their income and their debt. It requires 3% down. There's no private mortgage insurance or PMI, so that's going to definitely help the monthly payment. It's got a great fixed rate on it. And then we also will loan the 3% down payment requirement through down payment assistance.
So it seems like a great potential backstop for somebody who doesn't get those welcome home funds. Are there any additional requirements for the neighborhood program that may be different from, you mentioned the income, you mentioned the geographical, is there anything else specific to that program that maybe differentiates it when I'm looking at certain properties that may or may not be a good fit for?
So the property can't need a ton of repairs either. It is a conventional appraisal. But again, the appraiser could still note something that they see, and then it's up to the underwriter to decide if they want that to be addressed or not. But it is a conventional appraisal that we do. Seller can pay closing costs on it. You can get a gift as well. There's all kinds of options to help with that down payment as well. And you can also put more than the 3% down, because again, the more you put down, the less you're borrowing, the better that payment's going to be.
And that's not a finite program. That runs year round.
Year round, absolutely.
Okay. And really preparing for that is going to be preparing to see if you qualify for that program would be very similar to just a regular pre-approval.
Yeah. We would do an application and pull credit. It does require a 640 credit score. Make sure your debt ratio and everything checks out, and then after that you can get your pre-approval and start looking.
With respect to PMI, for folks who maybe have just heard it or heard their parents talk about it or think, well, if I don't have 20% down, it's all of a sudden going to blow affordability out of the water. What does PMI generally look like for a consumer? How do they calculate it or figure it out? Or
It's a good question. So private mortgage insurance is based off your credit score, it's based off how much you're putting down, and it's also based off the loan program you're doing. So there's a lot of factors that bake into it. Obviously, the better your credit score is, the better the PMI is going to be. Depending on the loan program, PMI can drop off once you get below 80% of the home's value, or it can stay on there until you refinance. So that's another reason you want to talk to a loan officer before you get out there and start looking at a house, just so you can ask those questions, because there's a lot with PMI. And believe it or not, there's a lot of first-time home buyers that think they have to have 20% down, and you don't. You don't have to have 20% down at all, but the catch-22 is typically you have PMI. But there are programs like neighborhood housing that don't require it.
so another feather in the cap for the neighborhood housing program. And what I have seen, clients who do need to utilize PMI or are required to have the private mortgage insurance, is there a certain point that if you're in conversation with your agent and they say, hey, we've seen sales appreciate in your area, do they have to do anything special to eliminate PMI if they're currently paying it, or what does that look like?
You can actually request with your bank or lender anytime that you want to get your PMI removed or reviewed. So if you bought a house, say a year ago, and you're noticing houses are selling for $20,000, $30,000 more than what you paid, and that might get you out of having PMI, you can call your bank or your lender and request that, and they'll give you the steps to take. And if you're below 80%, 9 times out of 10, they'll drop the PMI for you.
So important distinction there, because I have some people that are like, well, it should just automatically fall off. It's based off the
Original,
borrower
yes.
or the applicant driving the request for a review then?
Yeah. So if you do a loan program where PMI will automatically drop off, it's going to drop off once you're at 78% of the original purchase price. So if you're just making your principal and interest payment, and let's say you did 5% down, you didn't pay extra on your loan, your PMI is automatically going to drop off probably in year 9 to 11. You know, but more than likely your house is going to be worth a lot more than that during that time frame. So it's definitely worth keeping an eye on what's going out in your subdivision so that you can try to get it dropped off sooner, because it's going to make your payment go down.
So we touched on just general time appreciation, which is the closest thing to real estate compounding interest that I can think of. What about if I move in something and I make some improvements to it, but when I bought it, it was less than some of the comparable sales? Do I get an appraisal and then give that to you all so the bank can have a consideration of value? What does that look like if we physically improve the property and not just over time allowed it to appreciate? What does that look like?
You can definitely request to have a full appraisal done if you've done some major work inside the home, and it's an additional fee that you'll pay, but again, the outcome of it is possibly getting your PMI removed. So it's definitely worth requesting that if you feel that it's going to help the value.
Let's just math it real quick, bar napkin math. I mean, if an appraisal costs $500 or $600 and I'm paying, let's just say $100 a month in PMI, I think that's a no-brainer if it can save me over the long term.
Absolutely.
So I think anybody who's listening who's in a house paying PMI and they're not sure if their property has appreciated, reach out to your agent, see if it has. And or if you've made those improvements, still reach out to them and say, hey, based on the work that I've done, is my house worth enough for me to reach out to the bank and see if that's something that can be dropped off of my loan?
Yeah.
Does that happen pretty quickly? Like the review, what's that review process look like? Does it typically take a month, 2 months, or what's that look like?
It isn't a very long process at all. Fannie Mae has their own procedures and Freddie Mac has theirs. So when you reach out to your banker or lender, they're going to see who is holding or insuring your loan, and then they'll tell you what you have to do based off that. And as long as you're proactive and get on the ball and doing it, it can happen pretty quickly.
Talk to me some about the down payment assistance through Kentucky Housing Corp. What does that look like? We've touched on the neighborhood housing, the welcome home funds. We briefly touched on the Kentucky Housing or KHC program with the down payment assistance. How does that work?
So Kentucky Housing is a nonprofit out of Frankfort, and they loan all over the state of Kentucky. They are income-based loans as well, but the income limits are a lot higher than most loan programs. And again, it's applicant income. Now, they do have a mortgage revenue bond program that has a lower interest rate, and that is based off household income, but there's some things you can do to work around even on that to try to get your client to qualify for it. But Kentucky Housing does conventional loans. They do FHA, VA, and USDA, but they will pair it with their down payment assistance, or DAP, which is up to $12,500 that they will loan you to go towards down payment and closing costs. So it does help a lot with the burden of having to have your own funds to close.
Now, is that its own mortgage or is it with the first?
It is. That's a great question. So you would have your first mortgage, whether you're doing conventional, FHA, or whatever, and if you do down payment assistance, it is a second mortgage. And again, it's up to $12,500. You don't have to use that whole amount if you don't need it. And it's set up on a 15-year term. So I always tell clients, if you do down payment assistance and you want to pay extra on that down payment assistance. Get that knocked out, and your payment's going to drop about $100 a month.
Are there typically any prepayment penalties with that?
No, most home loans do not have prepayment penalties anymore.
Important distinction if you've been talking to your parents or grandparents about when they purchased a house, because I get that question a lot. And to your point, more often than not, the answer is no, there are no prepayment penalties. So if you go with the down payment assistance through KHC, you're looking at a first based on whatever program you're in, and then a second. Are they making two separate payments because it's two separate notes?
Yes, absolutely. They have two separate mortgage loan numbers and everything, both payable to Kentucky Housing.
Okay. Is there anything that you would suggest for people who may be on the fence right now? We were talking before we started the conversation. It seems like buyer sentiment is lower than it ought to be based on some of these macro and microeconomic factors that we see. What would you say to a buyer who's on the fence right now about, is this the right time, or what should I be doing? I'm tired of renting, or I've thought about purchasing, I'm living at home, they're not a homeowner now. What would you say to that person to give them words of encouragement or just words of wisdom from doing it as long as you have?
Well, the best example I can give is I had clients last spring saying, I want to wait until rates go down in 2026. Everybody was hearing rates were going to get better in 2026, and they have. The catch-22 is that house that they were looking at last spring is probably worth $15,000, $20,000, $25,000 more dollars.